I think I messed up, if I were China, that is. Billions are vanishing from Beijing's coffers, and the culprit, the Philippines. What started as a seemingly manageable partnership has spiraled into a costly standoff, with Manila turning the tables and draining China's resources. The spark, the Philippines' bold vow to defend its territory at any cost, and the sudden cancellation of lucrative Chinese infrastructure deals. New alliances with Japan, South Korea, and the US sent shockwaves through Beijing. Investing in the Philippines was no longer safe for China. The financial retreat was swift. Chinese investors watched their billion-dollar projects crumble overnight, while Manila rolled out the red carpet for global competitors. The Philippines was supposed to be China's Belt and Road gateway to Southeast Asia. Instead, it's become a financial graveyard, proof that checkbook diplomacy can backfire spectacularly. The world is watching as the Philippines turns every act of Chinese pressure into a strategic and economic disaster for Beijing. The yuan is under strain, shipping routes are shifting, and the Philippine flag is climbing on economic charts. This isn't just a territorial spat, it's a masterclass in how a smaller nation can upend a superpower's ambitions. China's losses are mounting by the day, and the message is clear. Overconfidence comes at a steep price. The Philippines has rewritten the playbook for regional power struggles, and now Beijing is footing the bill. The West Philippine Sea is now the epicenter of China's financial pain. Every act of Chinese aggression, ramming ships, boarding boats, reckless maneuvers has backfired, spiking risk premiums and driving up costs for Chinese maritime trade. The infamous collision between two Chinese vessels near Scarborough Shoal was more than a military embarrassment. It was a red flag for global insurers and shipping lines. International shipping companies now see the region as a conflict zone, rerouting vessels and raising insurance rates, making Chinese exports less competitive. Each incident, broadcast worldwide, has shredded China's narrative of a peaceful rise and fueled investor flight. Airlines and logistics firms are steering clear, wary of the region's volatility. The reputational damage is immense. China is now seen as a regional bully, not a reliable partner. Countries and corporations are de-risking, moving investments away from China and towards more stable neighbors, often the Philippines. The very waters China sought to control have become a financial liability. The cost of aggression is now measured in lost fortunes and lost trust. The real financial bleeding began when the Philippines withdrew from the Belt and Road Initiative in late 2023. Beijing's $24 billion in promised loans and investments turned out to be empty rhetoric. Projects stalled, terms predatory, and patience ran out. Manila's withdrawal was a declaration of economic independence, quickly followed by the cancellation of major Chinese-funded infrastructure projects. Billions in contracts vanished overnight, sending shockwaves through China's state-owned enterprises. The message was unmistakable. Maritime aggression has direct economic consequences. 4 of 10 flagship Chinese projects were abandoned or shifted to new partners from Japan, South Korea, and the US. The Philippines turned failed Chinese promises into a competitive advantage, inviting more reliable partners to build its future. This friendshoring strategy is Manila's most potent weapon, aligning its economy with a coalition of democracies. For China, it's not just about lost deals, it's about losing the entire country to a rival economic bloc. The pivot is irreversible, and the financial fallout for Beijing is massive. China's failed economic promises now haunt the Philippines like ghost ships, abandoned projects, broken trust, and public skepticism. The $24 billion Belt and Road pledge has evaporated, leaving behind half-finished infrastructure and a lesson: Chinese promises are unreliable. Global corporations are backing away from Chinese partnerships, wary of political risk and sudden cancellations. Instead, Japan, the US, and Europe are stepping in, offering better terms and stability. The US is investing in the Philippines' semiconductor industry, training thousands of engineers, a direct blow to China's tech ambitions. As more Chinese projects are cancelled, the perception of risk grows, fueling a vicious cycle of investor flight. Meanwhile, the Philippine economy is thriving, projected to grow over 6% in 2025, without Chinese money. The US has overtaken China as the Philippines' top export destination, with Japan close behind. Every container rerouted from Shanghai to Long Beach or Tokyo is a strategic loss for Beijing. The shift is dramatic and rapid, undermining China's economic gravity in the region. The ghost ships are a stark warning. China's influence is fading fast. The Philippines has built a powerful coalition, multiplying China's economic pain. The expanded US-Philippine Defense Pact signaled to the world, Manila is under the protection of the world's largest economy. After Chinese aggression, Washington reaffirmed its defense commitment, unlocking a flood of economic and strategic support. The US, Japan, and the Philippines formalized a new Pacific axis, channeling massive investments into infrastructure and supply chains. Japan is pouring billions into Philippine railways and maritime security, deals once reserved for China. The largest ever joint military exercises with support from Australia and France showcase the formidable alliance backing Manila. South Korea, India, and the EU are also deepening ties, eager to invest in a country moving away from China. This friendshoring web locks China out, making the Philippines indispensable to the world's leading democracies. Every new deal is a lost opportunity for Beijing. The alliance is costing China billions, and the bill keeps growing. Every Philippine victory sends shockwaves through the region, creating bigger problems for Beijing. What began as a maritime dispute is now a systemic challenge to China's dominance. Manila's defiance is contagious. Vietnam, Malaysia, and others are watching and learning. The economic domino effect is real. The Philippines' pivot away from China offers a model for others to follow. China's doctrine of economic dependence leading to political compliance has been shattered. To maintain its posture, Beijing must pour more resources into costly patrols and diplomatic campaigns, draining its budget. The Philippines, with a fraction of China's military might, is forcing Beijing into an unwinnable, expensive game. If China backs down, it loses face. If it escalates, it risks catastrophic conflict and sanctions. Manila has trapped the dragon in a costly dilemma. The dominoes of China's regional influence are falling, one by one. China's aggression against the Philippines is now a line item on its national balance sheet. Billions lost and more at stake. Cancelled BRI projects are just the start. Future revenue streams from a young, growing Philippine market are gone. Japanese, Korean, and American firms are now building the Philippines' future, locking China out for a generation. Military pressure is a constant drain. Naval deployments, maintenance, and personnel cost billions annually. This is money spent to enforce a rejected claim, not to generate value. China's reputation as a reliable partner is in tatters, making it harder to win contracts worldwide. The China risk premium has soared, forcing Beijing to offer sweeter deals and eroding its leverage. The ultimate loss? Its dream of regional leadership, shattered by coercion and mistrust. The Philippines exposed the sharp strings attached to Chinese partnerships. The financial and strategic damage may be permanent. China's miscalculation is rippling through its own network of allies. Countries like Laos and Cambodia, once cornerstones of Beijing's influence, are watching the Philippines pivot with growing unease. The Philippine experience is a cautionary tale. Chinese investment can bring debt, stalled projects, and political baggage. These nations are quietly exploring diversification, courting Japan, South Korea, and Western investors. If more ASEAN members follow Manila's lead, China's influence within the region will erode. The shift is subtle but significant. New trade talks, changing diplomatic language, and a re-evaluation of long-term strategies. China's friends aren't denouncing Beijing, but they're hedging their bets. The slow spread of doubt may be the most devastating consequence of all. China's financial losses in the Philippines raise a chilling question in the halls of the Forbidden City. Manila has created a replicable model of resistance: national pride, international law, economic diversification, and powerful alliances. The playbook is out: rally the nation, publicize aggression, disentangle from predatory investments, and build a coalition of friends. This formula is costing China hundreds of billions and shattering its aura of invincibility. What if more countries follow the Philippines' lead? What if Vietnam, Malaysia, or Indonesia adopt the same strategy? The Philippines may be the first domino, but a cascade could cost China trillions. The world has changed, and it was Manila that showed the way. The lesson is clear: even a superpower can bleed. The question now is